So we're here to discuss the Geneva report on the world economy that is focused on the rise of public debt, and it was issued earlier this year. A rise in private and public debt, not only in public debt, over the last decades. As you probably know, debt, as it has been signaled many times by, for example, by the IMF, has reached an historical height. And as a result of the COVID crisis, but also before, as a result of the 2008-2009 crisis, there have been a surge. And actually, the debt, in terms of public debt, the rise has been almost continuous for the average of advanced economies since the middle of the 70s. Should we be worried? That's the main question. And the report takes a fairly optimistic view on this. So let me quote. The report concludes, "The picture that this report paints is one of cautious and perhaps unexpected optimism. As long as credit supply remains plentiful relative to debt issuance and thus interest rates remain low, higher levels of debt are sustainable." That's almost a tautology, but the point that is made in the report is the trends behind the oversupply of credit will likely continue for a long time. Debt should not be ignored, but neither should it be feared. So that's the main conclusion of this very interesting report. Now, to discuss this issue, we have a distinguished group of panelists. We have Moritz Schularick, who is actually one of the authors of the report. He's from Sciences Po, University of Bonn. We have Agnès Bénassy-Quéré, Minister of the Economy and Finance of France. We have Giancarlo Corsetti, now at the European University Institute. And we have the market view from Silvia, Ardagna, Barclays. Now, I'm not going to summarize the report, including because we have one of the authors here. But I'll just mention some issues to be developed. Now, first of all, when out of 5 people sitting at this table are Italian, you can be sure there will be a lot of talk about public debt. That's the first consideration. Second, the issue of sustainability clearly hinges on the continuation, as it has been mentioned in the report, of an oversupply of credit, of savings and credit. This is not. This is a point that has attracted a lot of attention over the last few years by several observers, including Larry Summers, Olivier Blanchard, who have argued that this trend of oversupply of savings will continue, and we should not perhaps be too worried. One question that I would like to hear the views of the panelists about is whether it is relevant or not for real interest rates, and here I'm saying a sort of blasphemy, whether is it relevant or not that public debt has been entirely financed by printing money over the last 2 or 3 years. All debt, public debt in Europe, I think also in the US, has been financed by central banks, by printing money. Does it matter? I know I'm going to be accused of blasphemy because I say that money affects real interest rates. Perhaps it does for a while, for how long, we don't know. And certainly, in my view, it does affect interest rate if we're talking about seniorage. So printing money that does not create inflation seems to be, it's a real source of taxation. So I'm a bit surprised that when we discuss the surge of public debt over the last few years, we ignore that public debt has been financed entirely by central banks. And so the textbook dichotomy between financing deficit by issuing debt or by issuing money has virtually disappeared. It seems to me that it's a relevant issue. Even if there is no issue, another question, even if there is no issue of sustainability, is there too much debt financing which is leading to an overheating of advanced economies and perhaps emerging economies and inflation? And Related to this, if inflation is a problem, is it also a solution to the debt problem, if there is one? And finally, is it relevant to draw a distinction between debt in advanced economies and in emerging markets and low-income countries? So let's start. We have about 1 hour, a bit less now. Each speaker will have 8 minutes, and then there will be time for some Q&A from the audience and among the panelists. So the order in which I would like the panelists to speak is, I will start with Moritz, because he's one of the authors of the report, followed by Agnès, followed by Giancarlo. Agnès will focus, I understand, on inflation and the French public debt, and French public debt.
Well, the debt in general.
Debt in general. Giancarlo then will follow Agnès on the policy mix in the new environment, and then Silvia, who I believe will give us a less optimistic view. So without further ado, I'll give the floor to Moritz.
Wonderful. Thank you, Carlo. Thank you, everyone, for being here. Looking forward to this panel. And there is also Ugo joining us, who is the person who had a lot to do with this report and suggested it. So let me start by saying this is, of course, co-authored with Laurence, with Joachim, Oscar, and Alan. And indeed, when we published it there, and we discussed it in Geneva as well, there was a sense that maybe this was an optimistic report. If I look around, if debt was the topic that mobilized the crowds and the masses, probably this room would be a little bit more crowded. So maybe, maybe our...
It's Friday morning in Paris. So
okay. It's just one data point. I agree. I agree. Anyway, so debt, the eye of the storm. So what did we do in this 24th Geneva report on the world economy? We explore the economic risks entailed by high record levels of global debt. And we also say this is, and I think we hear more from this from Agnès and Giancarlo and Silvia, that this will be the backdrop for policy. High debt will be the backdrop for policy in the next decade or so. And we ask to what extent that financial vulnerability that is created and endemic in a highly leveraged world will shape policy making. And I'm really looking forward to also learning more about this. And when Carlo, when you said this maybe it sort of sounds optimistic, I think we wrote this against the backdrop. It's really easy to be pessimistic. It's really easy to always say like, oh, there risk, and it could be much worse, could be much worse. And I guess Europe is specializing in taking this, the glass is always half empty view of the world. And we wanted to, maybe with 2 Californian optimistic co-authors, we wanted to also look at the glass half full side of the world, which is, and this is I think the big point, this is the causes that got us into a lot of debt, on the private side at least, the savings glut, the great willingness of people to hold financial assets and accumulate financial assets will likely stay. And I think we heard a very similar message yesterday from Pierre-Olivier in terms of the factors leading to low global real interest rates, savings supply, deleveraging, low risk-free rates. We basically think that this backdrop is likely to be with us, which then makes you somewhat less, makes you think that interest rates will likely stay reasonably low, and that makes that debt situation hopefully bearable. Let me just give you some backdrop. So in the advanced economies, you know these, since the 1980s, we've essentially tripled the household debt and doubled corporate debt, and government debt has also expanded quite rapidly. So if you add them all up, we are definitely at record levels of debt, somewhere around 300% of GDP. In the emerging markets, the data started a little bit later on a comprehensive basis, but things have been equally, debt levels have grown equally strongly. At the same time, though, and this is our opening chapter, at the same time as the quantities of debt have risen so much and people are so worried about all this borrowing, the price of borrowing, the real interest rate, has collapsed. And I think these are 2 important phenomena to see together. It's the demand for let me just move on. If you live in a world where the demand for credit, demand for debt, if you will, has driven this borrowing boom, then you would have expected interest rates to rise. And instead, we seem to be in a world that's characterized by that left chart where you see what happens to the real interest rates and the quantity of credit in a savings supply, in a savings glut world where sort of supply shifts outward to the right, and at the same time, you get rising quantities of credit and debt and lower interest rates. And we also don't think that's the right insight, that we are in an investment shortfall world necessarily, because you wouldn't see rising quantities. But that's something to discuss, I guess. So why are we in this savings glut world? Well, one view is, and we heard Pierre-Olivier very eloquently about this yesterday. One view out there is that it has to do a lot with inequality. As the top incomes get a larger pie of the income share, and top income households have higher savings rates, just mechanically savings supply in the economy rises, and someone has to take the other side, so interest rates come down until other households come in to borrow. And you see this here, for example, for the US, see that 70% of total wealth growth in the US and about 60% in Europe has come from the richest 10% of households. And those richest 10% of households are the households that hold Agnès' public debt. So if we deflate a little bit, or we inflate a little bit away of that, we probably don't hurt households that need a lot of protection in that sense. So maybe from a distributional point of view, we shouldn't be too scared about this, but we can discuss this later. But it's pretty clear that if you look at the other side of this debt boom, who are the creditors? Who supplied the savings for this debt boom here to happen? It's pretty clear from the micro data, these are the richest 10% of households. Now you can ask, why do the richest 10% of households hold so much financial claims, so many nominal claims? It's a good question. There is definitely a question about portfolio choice and to sort of endogenize these choices, but I think we're very early in this literature. A fact is that a lot of these nominal claims, via bank accounts, via money market mutual funds, via government debt, if you look at the micro data, they're held by the richest 10% of households. The richest 10% of households also happen to be relatively old. So this is the second story that is there. There's a demographic story that higher life expectancy and a larger share of old people or old households in the population have led to the savings glut. And what is the point? Why do I show you this? I show you this not because I'm not also like concerned about credit and debt and financial vulnerability. Actually, I've built most of my academic career by looking at that. But just saying there is a flip side of debt, and that's called assets. And you could also look at the same chart and say that households have never been richer than they have today, because my debt is Agnès' asset. So we are effectively always looking at risks that lie in the distribution, and looking at gross global numbers, as we often do, is actually economically not very sensible. Anyways, the macro constellation, and I'm already coming up to my last minute or so. Yeah. The macro constellation underpinning the various savings gluts is likely to stay in place, and that means that if we look at household debt, we think that the deleveraging that has happened in the past decade since the crisis actually means that in developed countries, households are in relatively good shape. Let me move on to corporate debt. That's the dog that didn't bark. I think the number of zombie papers that are out there is growing by the day, but it doesn't seem to be a big issue. And we show in the report also that if you look at past corporate credit booms and you compare them to household credit booms, these are two scatter plots here. On the left-hand side, what happens after large credit booms on the corporate side. On the right-hand side, what happens to the real economy after large credit booms on the household side. You see that household credit booms are really different, and corporate debt booms tend to blow over. So you really need to screw up your financial supervision, as arguably Japan did in the 1990s. You need to get into evergreening and difficult political economy constellations to worry about corporate debt. So we and I think, I mean, so far we've been vindicated that corporate debt has been sort of the dog that everyone expected to bark and it didn't bark. Last word, we strike a cautious note, and I think we were broadly right on that on China already sort of mid last year, in the sense that China has really seen one of the largest debt booms in history. And maybe, and we think that China, and this was written at the time of the real estate collapses in China and the Evergrande and defaults, etc., that China might be able to avoid a hot crisis, but even sort of cold and slow, drawn-out deleveraging processes will take a large toll on economic growth, and I think that's what we think China is in for. A growth slowdown that is probably more substantial than people expect. Carlo, sorry for running over a minute, but that's...
20 seconds. Moritz, thank you very much. So the floor goes to Agnès now.
Thank you very much. So Moritz mentioned the idea of that inflation would inflate government debt away, and I wanted to discuss this notion of inflating away. What I'm going to say is personal views, of course. There is an electoral campaign in France, and I'm not supposed to say things. Fundamentally, I think this idea of inflating the debt away is related to a concept of inflation that would be demand-driven or monetary-driven with some financial repression. Today, hence you have an inflation tax. Today we have something which is different, where inflation comes from terms of trade shock and from bottlenecks in supply chains, as was elaborated by Philippe Lane in the first day of this conference. So I wanted to start with a very simple... So how?
I can do this for
okay.
you, or you do that. Yeah.
Okay. With a simple macro exercise. When you take a standard macro model, so this is a model used at the Treasury, but it is very standard in all other countries, and you simulate the impact of an increase in crude oil price by $25 per barrel. What you get, of course, is a fall in disposable income, GDP, so these are percentage points deviation from baseline. And more importantly, in our case, so this is first thing, you have a fall in GDP revenue, hence a fall in tax revenue, which may not be immediate, but will come after some time. So, and you have a slight increase in spending because unemployment increases, but most of the effect of the fall of real GDP goes through a fall in revenue. And if the elasticity is unity, you have a proportional fall in tax revenue. Then on top of that, if you have a terms of trade shock, then the consumer price index grows faster than the producer price index or the GDP deflator. I should have shown the GDP deflator, but I don't have it. And when you have a gap between the two, it means that this deteriorates the deficit. Why? Because spending, well, it depends on the spending, but more or less, spending rises with the consumer price index. Think about public consumption, think about social transfers that are indexed or not indexed, but still will follow the CPI. Whereas revenue is more or less based on value added, and value added follows the GDP deflator. So, so then you have, and if you look at the last line of this table, you see that the primary balance deteriorates after terms of trade shock. Okay. So on top of that, you have a lot of pressure to spend more, discretionary spending. So here you have the case of France. In Italy, you have the same kind of slide. So here you have three groups of spending. First is lump sum transfers to low-income households. Second is the subsidies to energy, what we call energy shields, so the fact that the increase in energy prices have been capped and this is subsidized. Of course, this is paid by the government. And then you have also emergency support to some businesses. So this comes on top of automatic effect of inflation. Now, coming into more detail, so first you have a part of the debt that is indexed on inflation, and in the case of France, it's 10%, which is not negligible. It's indexed, interestingly, it's indexed not necessarily on French inflation, it's indexed on euro area inflation. So when euro area inflation goes faster than French inflation, it's bad. Then you have automatically indexed social transfers, which are worth 500 billion euros, which means that each percentage point of inflation increases public spending automatically by 5 billion. And then there has been a lot of discussion about energy-related taxes and spending on two grounds. First, with higher market prices, the subsidy to renewables is less costly, and this is correct. This is correct. And second, VAT receipts with higher prices, VAT revenue inflates. However, we should keep in mind that first, VAT on energy will increase, but then to the extent that the saving rate doesn't decrease, then on total, VAT revenues will not increase. Because of if the share of spending in GDP stays stable, then you don't get an increase in VAT receipts in percentage of GDP. And then also because we should keep in mind that large part of energy-related taxes are specific taxes that are based on the volume, not on the value. So if consumers reduce their consumption of energy, which is good news, this will reduce tax revenues. And finally, you have also a possible impact on the corporate income tax to the extent that firms will not pass entirely the shock onto their customers. You have a reduction in profits, hence a reduction of corporate income tax. So you need to dig into the detail to get the impact, the exact impact of inflation, supply side inflation on public accounts. Now, if I come back to the snowball, so you know, of course, the equation, and here, so it should be R minus G, but I have separated the interest rate, nominal interest rate, and the inflation rate. So I is the interest rate, so we know that the maturity of the debt, so in the case of France, the average maturity of the debt is 8 years, so it takes time before an increase in, except for the part that is indexed on inflation, it takes time for the interest payment to increase, but then you have of course the growth rate that goes down, which goes against this inflation tax. And the second part of it is the primary deficit, and here ZT is the ratio between CPI and GDP deflator, and to the extent that this goes up, it will inflate the debt. And then you have the tax ratio, which is stable to the extent that the elasticity is unity. So the bottom line is that an exogenous increase in imported energy prices will temporarily reduce debt accumulation, but there are some elements that will reduce this effect. And the implications for the policy mix, but I have finished.
No, it's okay.
The implications for the policy mix, and then I will leave it to Giancarlo to develop. I think it's not such good news to have inflation to the extent that it comes from in terms of trade shock. The appropriate policy mix probably is not a fiscal expansion, but it's more targeted intervention and investment. And here you have a game between fiscal and monetary policy, with the idea that if there's no fiscal expansion, that maybe monetary policy will tighten less, which is better I think, than the opposite, that governments would stimulate the economy through a fiscal expansion, and then there would be more tightening of monetary policy, because what we need is more investment, actually. What we need to do in the coming years is to change the mix of expenditures of both the public and the private sector from consumption to investment. So what is interesting is to compare the COVID crisis with this crisis. So this is the previous Geneva report that we wrote with Giancarlo, and where we were saying that what was needed was a congruence between monetary and fiscal policy, which we have seen actually during the COVID crisis and even before, where fiscal policy was helping monetary policy to fulfill its mandate. And today we have a little bit of the same, where fiscal policy needs to be careful not to add to the inflationary pressure, but then monetary policy needs to respond by not too fast monetary tightening. So again, we need some congruence, which doesn't mean that the two need to be merged. Thank you.
Thank you, Agnès. I fully agree that for this specific episode of inflation, it is critical to distinguish between the CPI and the GDP deflator. I made this point myself on several occasions in Italy. This said, a couple of things I wanted to add. Public spending in the first year is allocated in nominal terms. So at least for the first year, you get a break from that point.
Not all of the spending, but it's true that spending reacts with more delay than revenue. It's true.
There is some spending that is increased as a result during the year, precisely as a result of increasing prices, and that's what we have seen in Italy. For example, allocations for public sector wages, allocation for spendings and goods and services, allocation for many transfers have not been frozen in nominal terms. So the first year you get that advantage. Some items are indexed, like pension spending, but they come with a delay. And then, of course, with a new budget, you have the chance of increasing some spending, the allocation in nominal terms. The second point I want to make is that the GDP deflator, anyway, does go up. So if you take Italy, for example, last year, the difference between CPI and GDP deflator was a disaster from the point of view that you made. This year, the government is projecting CPI inflation of 6% on average, and the GDP deflator at 3%. So in terms of some erosion of the public debt to GDP ratio, you get it. Not too much, but there is something. Correctly, you point out that there are index bonds, so that needs to be taken into account. The last point I wanted to make is that the inflation base is broadening now. It's not only... So if we look at the inflation rate in Italy, for example, in May, the CPI increased net of energy and food. The increase was 0.7 in a month. So it's broadening, which is actually, from that point of view, good news for the public accounts. Okay, now the floor goes to Giancarlo.
Okay, so the spending commitments that are coming are daunting. The good news is that, as Villeroy was stressing yesterday, there is a lot of private saving that in principle could be mobilized. The less so good news is it is hard to think that we can do that in a situation where some kind of minimum financial, fiscal, and macroeconomic stability is there, right? So I just refresh your memory with this picture, which is the unemployment rate in the US during and after the crisis, and the spread, the distance is the interquantile range across states. Now, this is Europe. As you see, there is an extra kick that you remember, in which not only the unemployment rate is higher with the euro area crisis, but also the dispersion is higher. The coming down is much slower. The narrowing of the dispersion is much slower. Now, why this is a good time to remember this thing? Because the lessons from this episode is in my view, is that, number one, tail risk is always endogenous. It's not an exogenous shock. Tail risk is when an exogenous shock comes in a situation when policy instruments are not sufficient to stabilize. Sometimes it's created by policy. The second thing is that tail risk always comes with a lot of market dynamics, belief-driven, self-fulfilling crisis. So you need instruments. You need instruments. Paraphrasing Pierre-Olivier Gourinchas, in turn paraphrasing Williamson, there will be no immaculate normalization of policy ahead of us. There will be no immaculate deleveraging. Everything will be possible on a narrow path. And this is why it's important to talk about the policy mix, something that we started 2 years ago with Agnès, Elga Barsch, and Xavier De Bruyne, and we hope to come back to it. Why policy mix? Not only because we need many instruments, more instruments, but also because we need to understand that these instruments will need to be coherent on two important dimensions. The first one is that in a situation like this, instruments are always complementary to each other. So we come out of a situation whereby at the zero lower bound, must be me.
Yes, it's you.
It's me. I am at the zero lower bound, people say money and debt have the same return. It is actually not true. Money and debt have the same return to the extent that markets do not attach a default probability on debt. And that has something to do with monetary policy, as we know from OMTs and as we know from the various program asset purchases. So monetary policy creates fiscal space, and it did, especially during COVID. Fiscal policy creates monetary space. So the complementarity is there, but it's not enough. The policy mix also comes only if the instruments are effective, are credible, in a vector sense, are independent, in the vector sense, or institutional sense. And it's clear that if monetary policy loses credibility, it's not good news for fiscal policy. Because, as you remember, once you lose credibility, not only you create the possibility of self-fulfilling, belief-driven crisis, also in interest rate and inflation, but also people will start to charge an inflation premium. So we need to be careful about this inflation solution to that, because it may not be a solution, and there are many reasons why we need to be very careful. But basically, what I'm saying is that we need also to face that the new environment in which we work now is totally different. And it's totally different because this change in relative prices is coming with inflationary tension, and monetary policy will have to act. Will have to act. Now, it may not be the only game in town, and it would be maybe wrong to think there's only game in town for inflation or whatever, but the point is that there will be some adjustment there. And there is where Europe is especially, this is a global problem, but for Europe it's a particular problem, because we need instruments such that monetary policy can still create fiscal space, right, in an environment with positive interest rates. So this was my reflections on the point that, the speech by Phil Lane was assuring. It may be true that the ball is now in the hand of the fiscal policy, in a way, but I don't know what the balance, what instruments we can think, especially in Europe, to do this, to walk this narrow path. It's almost a walking plank on the to keep things together. So my idea is that perhaps we are not far from the solution, because remember, talk about Euro bonds, common budget, may not be good. It may not be really an instrument for all seasons. In normal times, we may not need it. Subsidiarity or not, like coordination may be good. At time of crisis is essential. So in a way, we did that so far. The question is, what would be the space for guaranteeing, something that deliver enough macroeconomic stance and stability? This is an open question. I would like just to make a last comment on Pierre-Olivier yesterday. I think that the change in relative prices that we are facing is really, an enormous. I hope I'm wrong. There is a confidence interval, uncertainty, but relative price will change. Relative price is more than terms of trade. For countries who are importing energy, it's a terms of trade issue. A larger slice of our GDP will like to go abroad. And then we discussed with Agnès what is the effect on potential output. This is a big question for Europe. But there are also countries that have nothing to do, they have an energy balance. No? They will face the same change in relative prices. We'll create lots of imbalance internally. So this is an open question that our models sometimes are not particularly suitable, no? And of course, the implication for debt, credit, allocation of credit, and sustainability are very pervasive. I will stop here.
Thank you. Perfect. I mean, just one comment. I mean, you mentioned that the fact that you cannot rely too much on inflation because of what you call the inflation risk. That's very true. I've been working myself. I worked myself on several years ago on Turkey, which was a perfect example of a country which had inflation, high inflation, and real interest rates that were very high because of the depreciation risk. Okay, so Silvia, the floor is yours.
Some inflation may be good for other reasons.
For other reasons, yeah. I was just commenting on this point. We cannot take for granted that there will not be an inflation premium or an exchange rate depreciation premium.
Exactly.
Yeah.
Okay, thank you, Carlo. And it's not the only one; it's the Italian, with the exception of Carlo. All right. So Carlo anticipated that I was going to give not an optimistic picture, but when we discussed this in September in Geneva, I said I was broadly sharing the optimistic view of the report, with the caveats that the fiscal and monetary policy mix would have to continue to be such that growth could be robust, to basically anchor the public debt on a downward trajectory. Now, let me tell you a little bit what has happened between September, when we discussed this report, and now. And here I'm showing just, how growth projections, real growth, have been downgraded, and how much, some interest rates have basically repriced quite significantly. So, in a sense, if you think about, the key factor that the report was pointing out, the fact that interest rates were supposed to remain low as far as growth was robust, conditions to maintain debt sustainability, we are moving in a less favorable direction. So here I just put on the y-axis nominal GDP growth, on the x-axis different possible average cost of debt. And the numbers in this heat map are just the levels of the primary balances that are required to keep the debt stable. So the good news is that if you look at these red, numbers, those are, where in 2021, the level of primary deficit that both France and Italy could have supported to keep the debt stable. So very high, and the debt indeed went down because we had lower primary deficit. But now we are going to move basically along the vertical dimension from the bottom to the top. Interest rate expenses, as Agnès and Carlo highlighted, clearly they're going to move only through time, because the average maturity of the debt is quite long in euro area countries, but the growth picture is going to deteriorate quite a lot. And again, this is even allowing for inflation. The yellow, the purple numbers are basically using the European Commission nominal growth rate expected for the coming 2 years. And Agnès already, discussed various reasons why primary balances might deteriorate. Now, let me spend a couple of words on growth. I think it's pretty weak. When you look at different sources of growth, real growth for next year, you see that the picture is not that great. I mean, consumers are very downbeat.
expectations of consumption, of consumer confidence at a 12-month horizon, any indicators that you look is as low as it was during the global financial crisis. The labor market is strong, but has stopped improving. So if you look, for example, just at the unemployment rate in the last 3 months has not declined anymore in the euro area. And hours of work, in some countries they are above the pre-crisis level, in some others they are not. The second point that I want to make is that obviously I show you that financing conditions have already tightened quite a bit. I show you a chart of interest rate, but you can do some sort of like mix indices that consider spreads, rates at different maturities. And with Bill 1, you can see that there has been already quite a sizable tightening. And even though the average interest rate expenses will just increase over time, I think it's important to keep in mind the real cost of this tightening. And we did some work and we showed that obviously this has a differential impact across different countries. One of my colleagues, Ludovico, basically said, okay, let's assume that the market path of interest rate gets realized. How much of this path gets translated into lending conditions, and how much this lending rate change in different countries depending on how banks and sovereigns are interlinked. And obviously we get that countries that, banks that basically are more exposed to sovereign risks end up increasing the lending rates more. And growth obviously decreases by more, and decreases even by more when you are starting in a weak position. So if you do some quantile regressions, you basically have a negative impact on growth that is asymmetric across the various countries. The other risk that I want to sort of like highlight is that yes, so far, yesterday I think also was mentioned by in one of the lectures, so far we have not had bankruptcies, we have not had much of an increase in non-default, non-performing loans. But let's keep in mind that governments have provided very sizable guarantees to the private sector over the COVID crisis. Just take Italy. Italy provided something around, I think, 35% of GDP, according to IMF data, public guarantees, and some of these guarantees could become, actual liabilities if we start seeing a deterioration in the corporate sector balance sheet. The other, point that is important. I mean, Carlo mentioned to it, right? We should, lots of like this debt that has been issued during the crisis has basically been bought by the central bank. And here on this chart, I just give you some numbers of the percentage of net new issuance that has bought by the ECB during the past 2 years. And so, take Italy, it was 147%, 125%, 170% of net new issuance basically was bought by the ECB. So the ECB removed from the market more than the increase in primary in new issuance. I mean, next year, Italy has about 80 billion of private deficit, and there will be no QE. So clearly, this will have another, impact on financing costs. And things can be, we have learned it through the global financial crisis. I was, thinking while you were speaking, Moritz, referring to the structural issues of secular stagnation, lower real rate. I mean, there was the same even in 2012, but that didn't prevent for a fiscal crisis to happen. So we need to keep in mind these risks, in my view. And one channel that was important during the 2012 crisis was the continuous rating downgrades that rating agencies basically were providing. And when I discussed this in Geneva, I showed some results of determinants of sovereign rating, and I showed how increases in public debt had been offset by basically QE and monetary help. Again, going forward, we have to keep in mind that this might not be the case. And finally, 2 words. I mean, again, for in my previous life, I did lots of work on, fiscal consolidations. determinants when this fiscal consolidation could be or will be successful. And so I'm not claiming that you cannot do it. I just want to, remind that in real life the world can be quite different. And what happened in 2012 that we have to keep in mind is that, up front, governments had no plan for the, I would say, as extensive as fiscal austerity that they were forced to do when financing conditions tightened quite successful. And in the midst of the crisis, they also were forced to do it of the bad type of fiscal consolidations, the one that basically increased tax much more than reduced spending. So when we put all this together, I would say, again, echoing what Agnès and Giancarlo have said, the fiscal monetary policy mix is very important. I think that reducing fiscal risk should have come before than the monetary tightening. We are going the other way. I think it's important that things go gradual, and I think that we keep in mind that all these potential fiscal risks do exist and could materialize through these various channels, and things can unravel much faster than we thought, as Dorbush used to say. Thanks.